And away from matters of agriculture, let's turn attention to some banking-related issues because the Monetary Policy Committee of the Bank of Ghana has begun its 106th policy meeting today. The meeting is expected to last for some 3 days and will end on Friday, 20th May 2022, with the sole aim of reviewing the development of the economy, and it would also conclude on either or not to increase or reduce the policy rate. And so following this particular development, we have been joined on the telephone by an economist with Data Bank and the person of hello, good evening, sir. Hello, good evening, sir. Hello, good evening, sir. Can you hear me? Hello, good evening, sir. All right, so away from that particular story, let's turn attention to... Hello, good evening, sir.
Good evening, I can hear you.
All right, thank you very much for your time with us. Now, we want to find out from you that following the ongoing meeting at the policy committee level by the Bank of Ghana, what exactly are your expectations from this particular meeting, please?
Well, it's a dicey decision to be made at this point in time because obviously the Bank of Ghana's primary mandate is price stability, and general prices haven't been stable so far. I think from May last year all the way till now, we've seen inflation move from 7.5% all the way to the current rate of 23.6%. Now, you would realize also that beside the inflationary problem, which is mainly driven by higher petroleum prices, exchange rate pass-through, and then food price shock, I mean, we also have money market rates largely misaligned. The interbank rate, which is supposed to be below the policy rate, is some 187 basis points above the policy rate. And we've seen T-bill rate, which is also supposed to be below the policy rate, also above the policy rate, which is suggesting that it's cheaper for the government to borrow from the central bank than to borrow from the market, which is an anomaly. If you look at it from that angle only, it's easy, and the conclusion can be just one, that is to increase the policy rate, to arrest inflation, one, and to deal with these anomalies in rates on the market. But if you flip the coin to look at the fact that liquidity levels on the market is already tight, and inflation, if you believe inflation is a monetary phenomenon and that you can mop up liquidity in the system and that will help control inflation, the causes of the inflation are not mostly demand-driven. They are supply-driven and cost-push inflation, which are outside the scope of monetary policy, at least directly.
Okay.
It can impact the inflation through the indirect means, maybe through the second round effect, controlling the second round effect. So if you look at it that way, and the fact that liquidity in the interbank market is already tight, and the banks are borrowing among themselves now at a rate higher than what the Bank of Ghana is offering, then you dare say that, I mean, what liquidity are we mopping up in the first place? What that will result to maybe tighter liquidity conditions, which is stifle growth and increase the hardship we are seeing in the system. So while policy rate actions are recommended, the current situation with tight liquidity and then the fact that banks are already selling their investment to meet the liquidity requirements of government, I think the Bank of Ghana, I think that they might hold the rate at this meeting.
All right. So, Courage, do you actually foresee any upward adjustment of the current policy rate, which was actually reviewed last March by 250 basis points to 17%? Do you foresee any increment following the call by some economists saying that this is the time for the BOG to at least step up by increasing a policy rate?
Well, there is every justification for an increase. The point I have been making is that I'm saying there is every justification for further increases in the policy rate. The point I'm making is that for this May window, it appears liquidity levels are already tight in the market, and a further tightening can only stifle growth. So I think there is still room for some 200 basis point hike in the policy rate for the rest of 2022, but that could be deferred to July because at the current present circumstances, it appears liquidity levels are already tight, and then tightening the policy rate would only make things a bit difficult for everybody.
Okay. And its impact on the lending rate and then the local business community as well too?
Well, yes. Once the policy rate is going up, you expect the cost of lending to go up across board. I mean, already we have seen that T-bill rates have moved from some 12.5% in the beginning of the year now to now doing 18.88% at the last auction. We've seen the current 3-year bond that the government is auctioning, that book opening for tomorrow. It sent across the market a price guidance of 24%, when previously 3 years were being done around 17-18% really. So we've already seen cost increase across board. I mean, borrowing cost increase and lending rates to follow suit. And all of them are taking cues from the policy rate stand. So further increases in the policy rate just tightens credit conditions. And then that is the point I'm actually driving home, that under this present circumstance, if you increase the policy rate, you will only end up stifling growth because it might not help so much in controlling the inflation problem we have.
Okay, so Courage, you have stated that the current inflation that we are actually experiencing is not a demand-driven, but rather a supply-driven. In just 30 seconds, what should be done to at least curb the growing inflation rate?
There is no quick fix. We need to look at the policy interventions that can help address this. I mean, for starters, we've managed to control the CD now. The rate of depreciation has stabilized. That is a good step, and that was achieved through the mix of fiscal and monetary policy interventions. The next would be to tackle the things about food supply, which are more quick fixes really. But in the meantime, maybe input supply, fertilizer subsidies and stuff like that can help the farmers produce more for us, especially given that the rains have started quite early this year. Okay. I mean, the bit about fuel prices, there is very little we can do now but to build buffer, to pushing ourselves a bit.
All right. Thank you very much, Courage Botey, for your insights on this particular development. Thank you very much. Now, we have been speaking to Courage Botey, who is an economist with the Data Bank, for giving us up to speed what we need to do to at least cushion ourselves, and also what the Monetary Policy Committee of the BOG should be doing as their meeting is actually ongoing. And this is where we wrap up on business tonight. My name is Christopher Aticho. We were proudly sponsored